This is the reason most people will never build real wealth. And it has almost nothing to do with how much they earn, where they went to school, or how much they know about the stock market. The real reason is that they refuse to risk money. Not in a reckless way, not in a stupid gambling way. They just refuse to risk it at all. And that single decision, that instinct to protect every dollar at all costs, is quietly one of the most expensive financial choices a person can make. In this video, we're going to break this down properly. The psychology behind it, the data behind it, the real-world examples, and the hidden mechanisms that keep people stuck in financial mediocrity for decades. We're going to look at why your brain is literally wired to sabotage your wealth, why people who avoid all risk often end up worse off than those who accept calculated discomfort, and why the most dangerous financial product in the world is the one that promises you'll never lose money. This isn't theory. This is backed by decades of behavioral finance research, investor data, and real case studies of people who either mastered this principle or got completely destroyed by ignoring it. Let's get into it. Your brain is your biggest financial enemy. Before we even talk about strategies, markets, businesses, or investments, we need to understand what's actually happening inside your head when money is involved. Because the biggest obstacle to wealth isn't lack of information. It's not lack of opportunity. It's how your brain reacts to risk. Back in 1979, Kahneman and Tversky introduced something called prospect theory. And what they found is brutally simple. Losses hurt about twice as much as gains feel good. Let me say that again. If you make $1,000, you feel happy. But if you lose $1,000, the pain you feel is about twice as strong. This is called loss aversion, and it's hardwired into your brain. Now think about how this plays out in real life. You invest your money. The market drops. Even if it's temporary, even if it's expected, the emotional pain hits hard. Way harder than the satisfaction you felt when things were going up. So, what do? You sell. You pull out. You try to stop the bleeding. Not because it's the smart move, but because your brain is screaming at you to end the pain. Barclays Private Bank explained this perfectly in their work on the behavior gap. They pointed out that the amygdala, the part of your brain responsible for fear, triggers a fight or flight response. That leads to quick, emotional decisions instead of calm, rational ones. Losses are processed almost like physical pain, so your brain reacts the same way it would to danger. It doesn't care about your long-term plan. It doesn't care about compounding. It doesn't care about your 10-year strategy. It just wants the pain to stop. And when you listen to that impulse, you sell at the worst possible time. You lock in your losses, and then you sit on the sidelines while the market recovers without you. This isn't just a theory. This has been measured over and over again. Dalbar, a financial research firm, has been tracking investor behavior since 1994, and their findings are consistent and honestly kind of brutal. Year after year, investors underperform the market, not because they pick bad investments, but because they make bad decisions. They buy when things feel safe, usually after prices have already gone up, and they sell when things feel scary, usually right before the recovery. In 2024, the average equity investor earned 16.54%. Sounds decent, right? But the S&P 500 returned 25.5%. That's a gap of over 8%. And that gap isn't coming from bad luck. It's coming from behavior. Dalbar also tracks something called the guess-right ratio. Basically, how often investors correctly time their decisions. In 2024, that number dropped to just 25%, which means 3 out of 4 times, people move their money at exactly the wrong moment. 3 out of 4. As Dalbar put it, the problem isn't just bad timing. It's the psychological traps, emotional triggers, and flawed assumptions that cause people to act irrationally. So before you blame your income, or the economy, or the government, understand this. The most powerful force holding you back financially is sitting right between your ears. Now, let's zoom out, because losing a few percentage points in 1 year doesn't sound like a big deal. But over decades, it changes everything. Over a 30-year period ending in 2021, the average equity fund investor earned about 7.13% annually. The S&P 500 returned 10.65% over the same period. That's roughly a 3.5% difference per year. Doesn't sound like much. But here's what that actually means in real money. The average investor ended up with around $800,000. If they had just invested in the index and done nothing, no trading, no panic selling, no trying to outsmart the market, they would have ended up with over $2 million. Same time, same starting point. Over $1 million difference. Gone. Not because of bad investments, but because of bad behavior. Most of this underperformance comes down to timing. People buy high, they sell low, and they repeat that cycle over and over again. On average, investors hold their investments for just 4 years. In a game that rewards patience over decades, the risk they couldn't handle was doing nothing, just sitting still. And the cost of avoiding short-term discomfort? They gave up more than half of their potential wealth. Think about that. The people who tried to be safe, who tried to avoid volatility, who tried to protect themselves from temporary losses, ended up with less than half of what a simple, boring strategy would have given them. This is where a very old principle comes in. If you never risk money, you never build wealth. And the irony is this: the people who thought they were avoiding risk were actually taking the biggest risk of all. The risk of staying average forever. Now, let's talk about something interesting. The strategy that beat almost everyone was also the one most people ignored. There was a man who spent decades being mocked for his investment philosophy because it was too simple, too boring. His name was Jack Bogle. He graduated at the top of his class and joined the Wellington Fund early in his career. But in 1974, he founded Vanguard, and in 1976, he introduced something that completely changed investing: the index fund. The idea was incredibly simple. Instead of trying to beat the market, just buy the entire market. Accept average returns. Keep costs low and hold for the long term. That's it. No predictions, no trading, no chasing trends. Wall Street laughed at him. They called it Bogle's folly. The fund only raised $11 million at launch. Almost no one believed in it because it sounded like giving up, like admitting you weren't smart enough to pick winners. But Bogle understood something most people still don't. He once said in an interview, "If you're investing for excitement, you're a fool." And over time, that boring strategy became one of the most powerful wealth-building tools ever created. Vanguard is now one of the largest investment companies in the world, and index investing is no longer a joke. It's the standard. The real risk Bogle took wasn't financial. It was psychological. He risked being wrong. He risked being ignored. He risked sticking to a simple idea while everyone else chased complexity. Warren Buffett recognized this. In his 2016 shareholder letter, he said, "If a statue was ever built to honor someone who helped investors the most, it should be Jack Bogle." And he meant it, because the biggest advantage in investing isn't intelligence. It's discipline. It's patience. It's the ability to do nothing when everything in you wants to act. And most people simply can't handle that. Now let's take this one step further, because Warren Buffett didn't just talk about this idea. He proved it with real money on the line. In 2005, Buffett made a bet, a very public one. He put up $500. Siruzan challenged the best investors in the world to beat something incredibly simple: a low-cost S&P 500 index fund. That's it, no complex strategies, no insider insights. Just buy the market and hold it. The challenge was directed at hedge funds, firms packed with analysts, algorithms, research teams, and decades of experience. These are the people who are supposed to outperform, who are paid millions to outperform. Only one group stepped forward to accept the bet: Protégé Partners, led by Ted Sades. They selected 5 funds of funds, essentially layers of professional money managers, the best of the best, and then they waited 10 years. That was the timeline. Whoever performed better after a decade would win. Now think about what this really meant. On one side you had simplicity, low cost, no activity, just patience. On the other side you had complexity, expertise, constant decision-making, and huge fees. So what happened? Buffett won. And it wasn't even close. Over the period, the index fund delivered significantly higher returns than the hedge funds. But here's the part that really matters. Around 60% of the hedge fund's gains were eaten up by fees, layer after layer of managers taking their cut. So even when they performed well, investors didn't feel it. This is the part most people miss. The more complex something looks in finance, the more likely it is to benefit the person selling it, not you. Buffett's bet exposed something uncomfortable. The strategy that sounds too simple is often the one that works best, and the real risk most people can't handle. It's not losing money, it's being bored. It's sitting there while nothing exciting is happening. It's watching others chase trends while you do nothing. That's the discomfort. And that's exactly why it works, because most people won't stick with it. Now, let's flip this completely. What happens when people go to the other extreme? When they don't just avoid risk, but actively chase the illusion of zero risk. This is where things get dangerous, because when people can't tolerate uncertainty, they start looking for guarantees, and in finance, guarantees are almost always a trap. Take Bernard Madoff. He ran the largest Ponzi scheme in history, an estimated $65 billion, and what was his pitch? Consistent returns, around 10% per year, no volatility, no bad years. Just smooth, predictable growth. Think about how attractive that sounds. No stress, no downturns, no uncertainty, just steady money. But here's the problem. That kind of return profile doesn't exist in real markets. It's mathematically unrealistic. Harry Markopolos, a financial analyst, figured this out early. He tried to warn regulators. He even said Madoff's returns were like a baseball player hitting .966 for its entire season. Impossible. And yet, people ignored it. Even professionals, even institutions. Because the story was too comfortable, too appealing. Madoff also created an aura of exclusivity. Not everyone could invest with him. You had to be accepted, and that made people want it even more. It became a status symbol, a sign that you were part of something elite. And that psychological pull overpowered logic, math, and common sense. Eventually, it all collapsed, and Madoff admitted he hadn't actually been trading for years. The returns were fake. The entire system was built on trust and delusion. Now fast forward to something more recent, FTX and Sam Bankman-Fried. Different industry, same pattern. Investors believed they had found someone who had figured it out, who had mastered risk in crypto, who could deliver returns in a chaotic space. Behind the scenes, billions of dollars in customer funds were being misused. Financial statements were manipulated, and in 2022, it all fell apart. Bankman-Fried was later sentenced to 25 years in prison. Once again, people didn't fall for greed in the obvious sense. They fell for certainty. They fell for the idea that risk could be eliminated. Here's the principle, and it's non-negotiable. If something promises high returns with no volatility, it's either misleading, misunderstood, or fraudulent. Every single time. The desire to avoid risk doesn't protect you. It just pushes you toward hidden risks you don't understand. And usually, into the hands of someone who does. Now let's talk about something even more subtle. Because it's not just investing behavior that keeps people broke. It's spending behavior. And this one is dangerous because it feels like success. You earn more. You upgrade your lifestyle. Everything looks better on the outside. But behind the scenes, you're not building wealth. You're just maintaining appearances. This is called lifestyle creep. And it's one of the biggest silent killers of financial progress. Here's a stat that should wake you up. A 2025 Goldman Sachs report found that 40% of households earning $500,000 a year still felt like they were living paycheck to paycheck. $500,000 a year. And they feel broke. How does that even happen? Simple. Spending expands to match income. Every raise gets absorbed. Bigger house, better car, more expensive vacations, private schools, subscriptions, upgrades everywhere. So, your income increases, but your ability to invest stays the same. Or worse, disappears. And this isn't just anecdotal. Between 2020 and 2024, wages increased significantly, but savings rates dropped. People earned more and saved less. The extra money didn't go into investments. It went into consumption. And here's the uncomfortable truth. For most people, the psychological discomfort of looking less successful than their peers is stronger than the financial discomfort of taking risk and investing. There's a real-world example that shows this perfectly. 4 doctors, same profession, same income, around $300,000 per year. Over time, their financial outcomes were completely different. One of them spent around $80,000 a year, lived well, but below his means. He reached financial independence in about 11 years. Another spent around $200,000 a year, same salary, same career, but constantly upgrading his lifestyle. He ended up stuck in what researchers call golden handcuffs. High income, no freedom. The difference wasn't intelligence. It wasn't opportunity, it was spending. More specifically, what they chose not to spend. This ties into something deeper in psychology, a concept called hedonic adaptation. Here's how it works. Every time you upgrade your life, you feel a temporary boost in happiness. New car, new phone, new apartment. It feels amazing for a while. Then your brain adjusts. It becomes normal, and you start wanting the next upgrade. Your happiness resets, but your expenses don't. So you end up on a treadmill, spending more but feeling the same. Meanwhile, the person who resists that cycle, who drives a normal car when they can afford a luxury one, who doesn't upgrade everything immediately, that person is quietly building something powerful. Invested capital. And that's the only thing that actually buys freedom. Now, here's where it gets even more interesting. There's something called the wealth risk feedback loop, and almost no one talks about it. Research shows that as people become wealthier, their tolerance for risk increases. And as their tolerance for risk increases, they take more calculated risks, which leads to more wealth. It's a cycle, a reinforcing loop. Wealth, more risk tolerance, more opportunity, more wealth. For example, wealthy entrepreneurs tend to invest a much larger portion of their money into their own businesses because they understand what they're doing. They're not gambling. They're making informed bets, and they can afford to lose. That's the key difference. Someone with no safety net can't take the same risks, so they avoid risk entirely, and their financial growth stays limited. Now, to be clear, this doesn't mean you should start gambling or making reckless decisions. That's not the lesson. The lesson is this. The ability to tolerate calculated risk is itself a form of wealth. And the earlier you develop it, the more powerful it becomes, especially when you're young, when you have time to recover, when you have decades of compounding ahead of you. That's your highest leverage window. But it has to be done intelligently, with awareness, with a safety net. Because blind risk isn't strategy, it's just chaos. Now, there's one more force we need to talk about, and it might be the most underestimated of all, the people around you. Because whether you realize it or not, your environment is constantly shaping your financial decisions. Dalbar didn't just identify loss aversion. They also pointed out other behaviors that destroy returns. Anchoring to past experiences, overreacting to news, and one of the most powerful of all, herding, or copying what everyone else is doing. And this shows up everywhere. When your coworker sells everything because the market looks scary, you feel that pull. When your friend starts making money on some trending stock or crypto, you feel that pull. When people around you upgrade their lifestyle, you feel that pull too. This is social proof, and it's incredibly powerful because humans are wired to follow the group. It feels safe. It feels natural. But in finance, following the crowd usually means doing the wrong thing at the wrong time. Buying when prices are high, selling when prices are low, chasing trends, panicking during downturns, repeating the same cycle over and over again. And here's the part most people don't want to hear. Your results will eventually start to mirror the behavior of the people around you, not your intentions, not your knowledge, your environment. So, if you're surrounded by people who panic, overspend, and chase short-term gains, you'll slowly drift in that direction, even if you know better. Now, the solution isn't isolation. Cutting yourself off from everyone isn't the answer. That creates blind spots of its own. The real solution is curation, choosing your environment deliberately, surrounding yourself with people who think long-term, who understand that volatility is normal, who don't react emotionally to every headline, who value patience over excitement, because over time that mindset becomes your default too. And this isn't just theory. Research has shown that differences in risk tolerance can directly impact wealth outcomes, even explaining measurable gaps in accumulated wealth. So, the people you listen to, the conversations you're part of, the mindset you're exposed to daily, it matters more than you think. Now, let's talk about something deeper. Why this is so hard in the first place. At the core of all of this is one fundamental human struggle: delayed gratification, the ability to sacrifice today for something bigger tomorrow. In theory, it sounds simple: spend less, invest more, wait. But in reality, it's one of the hardest things for people to do. Research from the American Economic Review found that most people don't actually plan their finances rationally over the long term. They react. They use shortcuts. They follow what feels right in the moment instead of what will benefit them over decades. This is explained by something called hyperbolic discounting. Basically, we value immediate rewards far more than future ones. So, spending today feels better than investing for tomorrow, even if we logically know it's the wrong move. And then, there's another layer, mental accounting, a concept introduced by Thaler. People treat money differently depending on where it sits. Money in your bank account feels spendable. Money in an investment account feels untouchable, even though it's the exact same money. And because of that, people make irrational decisions. They spend freely in one area while being overly cautious in another. The person who can override this, who can look at $1 today and see what it becomes in 10, 20, or 30 years, has a massive advantage. Not because they're smarter, but because they're willing to endure discomfort. Because that's what this really comes down to, the discomfort. The discomfort of not spending. The discomfort of not upgrading your lifestyle. The discomfort of watching others enjoy things you could afford but choose not to buy. That's a risk, a social risk, an emotional risk, and most people can't handle it. So, where does all of this leave us? If your brain is wired against you, if your environment is constantly pulling you in the wrong direction, if your lifestyle naturally expands to consume everything you earn, and if there are people out there actively trying to exploit your fear of risk, what do you actually do? Let's simplify it. Here are the principles that consistently show up in the research. First, if you're given a choice between steady, realistic returns and the fantasy of high, guaranteed returns, most people choose the fantasy. You can't afford to do that. The boring path, market-level returns over decades, is what builds wealth. The risk-free shortcut is what destroys it. Second, if you stay invested through a full market cycle, 7 to 10 years or more, you dramatically increase your chances of success. Your job is not to predict the market. Your job is to survive it. To stay in long enough for compounding to do its work. Third, your income doesn't determine your wealth. The gap between what you earn and what you spend does. If your spending rises with your income, you stay stuck. Protect that gap because that gap is your future. Fourth, automation beats willpower. If you invest before the money hits your account, you remove the temptation to spend it. You also reduce the chances of panic decisions. But this only works if you have a safety net. An emergency fund is not optional. It's what keeps you from being forced to sell at the worst time. Fifth, early. Calculated risk is your biggest advantage. When you're young, you have time. You can recover. You can learn. And you can compound. The earlier you start taking intelligent risks, the more powerful that feedback loop becomes. Sixth, be intentional about your environment. The people around you will shape your financial behavior. Find people who think long-term, who don't chase trends, who understand patience, because that influence compounds just like money does. Seventh, if someone promises consistent high returns with no volatility, walk away immediately. That promise has been at the center of every major financial disaster, from Madoff to FTX to countless smaller scams you've never heard about. The safest-looking opportunity is often the most dangerous. Now let's be real for a moment, because none of this is perfect. There's survivorship bias in every success story. We hear about Buffett. We hear about Bogle. We don't hear about the thousands who took risks and failed. Risk is necessary, but it's not enough on its own. Skill matters. Timing matters. Access matters. Even the data we've talked about, like Dalbar's research, has its critics. Some argue that it overstates how much behavior alone impacts returns because there are other factors too. Fees, income constraints, unexpected life events. And that's true. Not everyone has the same starting point. Not everyone has the same opportunities. Telling someone with no safety net to just take more risk isn't helpful. So, the principle has to be applied intelligently. This is not about gambling. It's not about chasing trends. It's not about throwing money into things you don't understand. Wealthy people take risks, yes, but they take them in areas where they have knowledge, where they have an edge, where they understand the downside. That's a completely different game. So, here's the bottom line. If you never risk money, you will never build real wealth. That's not just a bold statement. It's backed by decades of research, by investor behavior data, by real-world examples, and by the patterns we've seen over and over again. Your brain will try to stop you. It will amplify losses. It will push you to act emotionally. Your environment will pressure you to spend more, to follow the crowd, to chase what's trending. Your lifestyle will try to expand to consume every raise you ever get. And the people promising easy, risk-free money will always be there, waiting. The path to wealth isn't complicated, but it is uncomfortable. It requires you to accept volatility, to embrace boredom, to live below your means, to stay invested when everything around you says to sell, to take calculated risks early when you have the most time to recover. And to do all of this while most people around you are doing the exact opposite. The average investor ends up with around $800,000 over 30 years. The one who simply stayed consistent ends up with over $2 million. That difference? It's not intelligence, it's not income, it's not access, it's behavior, it's discipline, it's the willingness to tolerate discomfort. Machiavelli understood this centuries ago. Fortune favors the bold, not the reckless, the bold. If this story changed the way you look at the risks you take and the wealth you build, then subscribe to follow our channel. We are uncovering the financial truths that many try to keep hidden. Let's build a future of freedom. The next treasure of knowledge will be revealed soon. Like this video if you're ready to master your own behavior.